Welcome back to John Author's Note. For the past few crisis-hit years, financial markets have very often all moved in the same direction, like a roller coaster, mesmerized by single events, such as what's going to happen to the future of the Eurozone. There have been moments of panic, followed by periods of relief. But what we've seen in the past few months and weeks is a return to more normal market conditions. Investors have focused on individual currencies or countries or fundamentals. But the question is now, will the events we've seen in Italy or in the US on fiscal problems put us back on the risk-on, risk-off roller coaster? With me to discuss this is Stacy Williams, who's a senior strategist at HSBC, who compiles the so-called RoRo index, which we can see in our first chart here. Stacy, tell us the story here.
Well, what we do here is track correlations across lots of assets.
That's everything moving together? Or?
Everything moving together, and because individual markets might be peculiar at any time, we track 30 assets from around the world, different asset classes.
Bonds, equities, currencies?
Bonds, equities, currencies, gold, soft commodities, it's all in there.
And what do we see? We see this is the crisis years towards the end, a very steep increase.
Yes, well, it's a pretty stable index for many years, decades in fact, and at Lehman it explodes up and becomes extremely high, and we've seen this fall down in the last 2 months.
This is right at the end there. What's been causing that fall then? Is this end of risk on, risk off?
Well, it must be highlighted that yes, it's fallen a lot, but only versus the extreme highs in the summer. So it's still relatively high. But what we think's caused this is the fact some of the major causes of concern have calmed down a bit recently. The
causes being Eurozone.
Eurozone, fiscal cliff, China hard landing. They're not as imminent as they were in the summer. Yes.
And presumably that's to do with the central banks as well. The central banks saying it's going to be all right.
Yes, policy intervention of various sorts tends to kind of calm markets for periods, yes.
Okay, now the big question, of course, we've had Italian elections last week. We've also had renewed tensions over US fiscal position and so on. Do you think that chart's going to go back up again?
I think it probably will, because when we see these correlations fall, it can often be just because things are kind of subdued rather than because they're really fixed.
Yeah.
So I think as soon as we have a bit more nervousness and jitteriness, then this chart's likely to
It's quite a roller coaster we've had for the past few years.
It is. Well, this thing has been lower a number of times since the crisis began, so it does tend to be rather volatile, yes.
A lot of people I talk to say Italy's different because things have calmed down. If the indecisive election had happened a year ago, we would have been in a catastrophic situation, but things have moved on. You would beg to differ?
Yeah, I think so, because it's not just about the Eurozone. I mean, before Greece was even a problem, we saw this index at very high levels. So at any particular time, the market can focus on, say, Europe, but there are more kind of systemic risks out there.
I know you brought some, your second chart you brought along to support your point. Tell us, looks very exciting, Italian election night, what happened there?
Well, the world seems rather less normalised on nights like this. We have fears in the Eurozone after the Italian elections, and here we have a variety of different markets, S&P, oil, Kiwi against the yen, which is a pretty kind of risk-loving trade, and Eurodollar.
So what the point is that this is during the day in London time, so during the day everything was pretty calm, but then by the afternoon we start to getting the results coming out in Rome, and everything moves together.
Yeah, I mean, this is running through that day, and even before more details of what was happening in Italy came out, you can see the markets are kind of drifting down together. But once the news starts to get bad, they all move very closely in tandem again.
Yeah. Even the little dips within the day, they're pretty similar.
Exactly, and you can see here that the big dip is really quite pronounced.
But these are very different things. We've got the euro dollar, we've got the Kiwi, the New Zealand dollar. I mean, what's the relationship between them?
Well, this is the great feature of risk on, risk off. You have a common, we believe, risk premium in all these very different markets, and that's what's really causing this move.
But since last week, since last Monday night, things have calmed down a bit, but just temporarily.
Well, indeed, but it shows the capacity for these markets to really all kind of move on the same sorts of news, and that's something we didn't see pre-crisis.
Okay, Stacy Williams, thank you very much. So what we've seen is a reduction in risk on, risk off, but if Stacy's correct, it won't be too long before we're back on the RoRo roller coaster.